Bruce, you want to start?
I think there is a cultural shift that is going on, and I don't think it's temporary. In Europe, for example, there's no stigma to renting. In Paris, people rent for generations, and affluent people do. And people have witnessed a decline in the home ownership market and realized that the American dream ain't what it's cracked up to be. And so we are not losing people to condo purchases anymore. The pendulum, will swing at some point, but I think people are realizing that there's a tremendous amount of wisdom to renting, and that bodes well for the future of this business. We are seeing significant rent growth, and at a time where the supply growth has not really kicked in yet. So it is the perfect storm in reverse here, and everyone on this panel can go buy a new pair of shoes this year because it's been a wonderful year.
Harold, how do you feel?
Well, I find this very interesting because starting in 2009, I was asked to give a talk like this on the future of the multifamily. And I remember in 2009, we were at the bottom of the cycle, more than that later. And vacancies were 8–10%. We're giving 1 or 2 months free rent. And everyone was walking around with a very sour puss, very, very depressed. At that time, we said, we are at the bottom of the cycle, we're coming out, cap rates are high, you can buy things for a song, banks are lending money, employment is starting to creep up, now is the time to buy. 3 years later, this is exactly what has happened. In the last 3 years, we have acquired about $230 million worth of property with cap rates around 6 or 8. These same properties now have cap rates at 4. So those of you who didn't attend or did attend these talks, blew it if you haven't bought anything in the last few years, because now the cap rates at 4, the rates are high. However, you still have a way to go. Employment is increasing. In Boston alone, one of the previous panelists mentioned, there's 250,000 jobs that will come up, less jobs now than they had before. Those 250,000 jobs, only if 10% rent is 25,000 apartments you're going to need. And that's what's going to happen. So we're starting to increase rents, but be careful, careful, careful. If you raise the rents too high, you're going to have a backlash that once the rent control can come back in, at some point, tenants just aren't going to pay it. They're going to go back to their families' houses, they're going to double up, and all these new luxury buildings, which are being built now with the demand, they won't rent because there's just a limited number of rich people around. And they're going to start lowering the rents. But our rents, like Bruce and myself, are 60% of the current rents, so we'll go lower. If you'll have buildings you want us to buy, we will buy them. So I think you've got a great future for the next few years, and I brought with me our favorite. I don't know if we want to get to it now or
Sure.
The first one. Yeah, I assume most of you here speak Chinese. No? Well, let's show them the second one, and that'll be more exciting. In the last 160 years, there have been 14 down cycles in the real estate field. And the up and down is inexorable. It's like death and taxes. I don't care what happens. You're going to have down and you're going to have up. And whenever you have a downturn and prices go down, at the next downturn, the rents are always higher.
We're right here.
And we have started the turnaround, and I've got the next downturn, 2024. I could be off by 8 years. Believe me, something will happen that will cause it to turn around. Rates can get too high, as I said before. There'll be a lot of vacancies because they can't rent these expensive apartments. and that'll be your next buying opportunity. So, I think paying attention to the real estate cycle is very important. And with that in mind, and with the other factors that affect the residential market, that's what the future will be.
Bobby, I'd just like to touch with you. What do you see as the current drivers in your rental business?
I think Bruce talking about the home ownership rate is absolutely right. I think it's about 2.5 million homes in Massachusetts. A 1% change in the home ownership rate is 25,000 homes. Harold talked about 25,000 apartments needed for the new jobs. I think the 3,000 apartments being built next year doesn't come close to meeting that demand. I don't know if it's 8 years off, but I think we do have a long way for demand. And I think the third piece is Generation Y. The oldest of them are about 30, 31. The youngest are about 10. They're still coming. There's 800,000 more Gen Yers per year than Gen Xers, and that demand is also pushing, and they're going to want to rent. They're much more risk adverse than people ahead of them. They see the value in being able to move, to stay and find a job, and not be tied down. And I think those are the three factors.
You know, you say 1%. Today, home ownership is about 65% of the population. 1% decline in home ownership results in about 1 million more renters.
In the whole country.
In the whole country.
I was keeping it to
So,
Massachusetts.
and that's what's happening. People are getting into renting rather than home ownership. But that will change. They'll start rehabbing all these vacant houses, 1 million of them. People will start renting, and people will start buying it. There'll be less renters. Be careful. That's all. Be careful.
You know, I think I sat in this panel last year and was fairly bullish for the reasons you've already heard. Excited about the demographic growth of the upcoming generation of renters. Certainly saw very little supply, and at that time really felt as though we were at the beginnings of a nice, solid recovery. We've been down for a long time, and it looked as though we were ripe for some real growth. In hindsight, I think 2011 was a little bit of the calm before the storm, and I mean that not necessarily in the most positive way. We certainly stalled as a world economy. Places like Boston are actually an exception. We created 60,000 or so jobs, 2+%. Here, virtually all of those were inside 495. We had yet to be able to ramp up the supply. So the supply piece is actually pretty straightforward in terms of figuring out 12 and 24 months ahead, just based on what it takes to put an asset in place in the first instance. So, you know, we knew there wasn't going to be a lot of new supply. We expected there to be tremendously strong demand. It was very strong, but not up to the level that certainly I had expected, except in places like Boston, followed by maybe DC and New York. But in other parts of the country, certainly where we operate, Southern California is probably the other end of the spectrum, the economy is still stuck in the mud. So basically 2011 was a pause. It was as if someone hit pause. The good news was not much got delivered. I think we're about to reverse that. There certainly is a pretty good chunk of supply coming in many markets, including here, but hopefully it'll be accompanied by continued decoupling of the households, kids moving out of mom's basement, kids actually getting their first job, people going to one bedroom from a roommate situation, whatever the case may be, and overall generally a stronger economy. The propensity to rent is really the most interesting piece, and Harold hit the nail on the head. A 1% shift makes a huge difference in the rental world. You know, if we went from close to 70-30 down to what the historic norm was, which is about 64-36, that's 20% shift upward in rental. And the reality is, it really happens in what I would say the income levels are sort of the battle zone, right? Those folks who could otherwise afford are making a decision. So if you look at the high-priced buildings that are to be delivered either here in the Seaport or elsewhere around Boston, the people who can afford to rent those are those people on the bubble who are making the decision to rent versus own. And frankly, a 1% shift in that group has an enormous impact because that entire delta is coming from that borderline folks. Those households, I didn't describe that well, but that household right at that point is really driving the market. And when you have firms like Vertex adding 1 million feet here, you've got to believe that will continue to propel high-paying jobs centered closer to the urban setting, which will fill the new apartments that are being built.
You know, Bill, now people like Bruce and myself, with the Class B properties, not the new ones we're building, we talk about vacancy rates, where they were 8, 10, and now less than 1%, I'm sure yours is too. But next year, the next couple of years, just next couple of years, you're not gonna talk about vacancy rates. You're gonna talk about, hey, how many days was that on the market? There won't be a vacancy rate. They'll snap them all as soon as they come up.
I think we're almost there now. Our vacancy rate is essentially 0. And
21%.
but the scenario right now in this price point, in the Class B price point, is so attractive, and the new development is really another world, and I'm sure we'll get into that discussion, but I do worry a little bit for those developers that are all competing at the very high end, and I think that's where the risk in this market is
Bill,
going to be.
we're gonna be very fierce competition.
Well, I think, Bruce is certainly hitting on a point that I differentiate the urban from suburban. That last cycle, we did a great job of supplying Class A suburban apartments. And the net result was the suburbs